The next strategy I want to talk to you about is called the Seller Payment Subsidy Program. This program enables you to take the same $27,500 concession from the seller, but instead of reducing the price, you're still going to offer that $800,000, but we're going to take that $27,500 and use it to subsidize your mortgage payments for the next 3 years. In the next 3 years, I believe there's going to be an opportunity to restructure this indebtedness to a lower rate. This is not a 30-year problem with mortgage rates. This is a 6 to 18-month problem that we got to solve for. So the cool thing about this strategy is the seller gets the same amount of money as if you offered $772,500. But this $27,500 goes into an escrow account offsetting your payments, which means for the first year, your payment's only $3,527, saving you $1,126 per month for the first year. Now, that's because the first year, the payment is based on 3.99%. The second year, the payment would be based at 4.99%. The third year, the payment would be based at 5.99%. And then for the rest of the mortgage, the payment would be based on 6.99%, with the intention to refinance somewhere in year 1 or year 2.
And that's using the seller's money, not mine.
That's using the seller's money, not yours, to reduce that payment. Exactly right. So just to kind of give you an idea here, I created a payment stream for you. So on the subsidy buy down, you'd save $1,126 in payment the first year, $770 the second year. So it's roughly $350 in the second year your payment would go up. And our goal would be to refinance somewhere in this range. By the way, guys, this doesn't include taxes and insurance. That's why the payment amount is less than what I have over here for payment, but that would include your taxes and insurance. Year 2, that payment would go up by about $350, still leaving you below the crucial $4,000 cutoff.
And gives us 3 years to get it to where we want it to be if rates.
That's right. And one other thing just to think about, Colin, most people receive, some sort of annualized raises. And if your income is going up 3% a year, which is, kind of like national average, 3 to 4%, that means your income's going up $3,000 to $4,000 a year. You've got another $300 to $400 a month in your budget that could use to kind of offset those graduated payments. So even in a worst case scenario world, your payment's probably going up hypothetically in line with what potential future income raises could be. So as a fallback, you at least have future income increases in the future to probably count on. And here's what I think a future refinance would look like. I think it's very likely that we end up somewhere in this 5.5 range. Again, I'm going to be managing that with our mortgage under management process, where we're going to set a strike rate. And as soon as it makes sense to refinance, I'll be notified. I'll reach out to you proactively so you don't have to be left on your own to manage this. At the end of the day, we would be looking at a payment. If we got down to 5.5, don't worry about this down payment, because you'd already have made that when you bought the house. I'm just trying to give you an illustration where payment would be. If we could get you down to 5.5, that would put your payment around $4,073, pretty close to where your goal was.